Welcome to the Capital Exchange. I'm Steve Wilbur, Managing Director at Allen Capital Group.
And I'm Travis Portwood, Chief Investment Officer with Allen Capital Group.
Travis, the wealth management industry continues to evolve. Going back to the 80s, we had brokers selling individual stocks, and then in the late 80s and 90s, mutual funds really had picked up steam. They offered us diversification, and moving into the 2000s, the shift we saw was to ETFs, also known as exchange-traded funds. Due to their transparency and tax efficiency structure compared to the mutual funds, but the landscape continues to change, doesn't it? It's easy for me to say.
Yeah, it really does, Steve, which I think is a positive. So tax efficiency. With mutual funds, capital gains can be pushed out to the investor towards the end of the year, regardless if they sell the funds or not. ETFs solve some of this issue with their internal tax-efficient structure. However, if you hold a specific index ETF for a long period of time in a non-qualified account, you potentially accrue significant capital gains, potentially holding you hostage down the road if you don't sell some or all of that position for tax-sensitive reasons. So now we're seeing another shift. Enter direct or custom indexing, as it's called.
Yeah, with custom indexing, Travis, we can achieve even more tax efficiency, as you mentioned. Instead of holding a mutual fund or an ETF and creating a portfolio of, we can create a portfolio of individual stocks that actually replicate the underlying index, such as the S&P 500 or the Russell 3000. We then look for opportunities to harvest losses daily with the goal of similar performance back to the index like an S&P 500 without occurring the unrealized gains that might hold you hostage like you mentioned earlier.
Yeah, so Steve, tax loss harvesting opportunities exist in all type of markets, and we'll use the S&P 500 again here in our example. Painful years like 2002 and 2008. Don't dig too deep into that. You'll traumatize yourself.
I blocked it out.
Those years, almost all of the stocks included in the index experienced some kind of drawdown during the year that we could have taken advantage of. Even in great years like 2013 and 2019, great years for the S&P 500. Yeah. Over 50% of the stocks in the S&P 500 experienced a drawdown at some point that we could have taken advantage of. For example, selling one position, say selling Coke or Pepsi, and buying the other, harvesting a loss but creating a similar exposure for upside capture.
You know, Travis, another great feature of direct indexing is the ability to customize the portfolio based on your beliefs or values. For example, if you want to invest according to ESG principles, which stand for environmental, social, and governance, we can screen out companies based on an ESG standard to eliminate companies that may not meet your values or beliefs.
Yes, Steve, and the customization feature really lets you put your stamp on the strategy, if so desired. The flexibility here is nice. For example, if you work for a specific company and perhaps maybe you have a concentrated position in a company, we can eliminate that from your specific index so we don't buy any more of it, compounding the problem. Or we can invest according to, say, Christian or Catholic values, metrics, if that's important to you. Bottom line here, Steve, is direct indexing is here. It's a new level of customization and tax efficiency for people when it fits their portfolio needs and objectives.
I can't agree more, Travis. This has been great. I look forward to it next week.
Look forward to it as well.